I'll hit my backup to test. Okay. Let's just give Dennis a marker. So I'll do 3, 2, 1, and then we can both clap our hands, and he can use that as a marker to line us up at the beginning. 3, 2,
okay.
1.
Yep, sure.
3, 2, 1. I didn't even hear your clap.
You're trying to watch me clap and do it at the same time, but there's a lag.
I know.
In fact, there's a lag when you say 3, 2, 1.
Let's do it again then. 3, 2, 1. Wow, that's a big lag.
Yeah.
Welcome back to QAV. This is episode 607. We're recording this on Valentine's Day. Happy Valentine's Day, TK. It's 14th of February, 2023, and we got a lot of lag.
Happy Valentine's Day to you too, and to our lovely wives.
Yes. Do you? I know I ask you this every year, but are you celebrating Valentine's Day this year?
No. Jenny walked into the apartment yesterday with a bunch of red roses, and I went, "Oh, they're nice. What are they for?" It's like, didn't even think about it.
They were from you? You had your people send them?
No. They were from her.
To you?
I don't know.
Or to herself?
Just to herself, I think.
Oh.
She's pining away, waiting for me to send flowers. And then about an hour later, I walked in and went, "I got it. That's why you got roses. I'm sorry I didn't get you anything." And she said, "That's fine." She said, "I hate Valentine's Day. I just saw these on the street and bought some because they look nice."
Right. Yeah, we don't.
So she's either being very diplomatic, which she does a lot, or or you're right, we don't celebrate Valentine's Day.
Yeah. Well, let's get into portfolio.
You?
No, we don't do it. We think it's a crock of shit. And it was Chrissy's birthday a week ago, so we did a lot of stuff then, and we're not going to do more stuff. Took it to Hamilton. We went out. It was a good time. I'll talk about it later in after hours. Won't bore people with that.
Mm-hmm.
Let's start off with maybe some portfolio updates. I think, Tony, let people know what's going on. Let's have a look at the dummy portfolio, the QAV dummy portfolio for new listeners that's been running since beginning of September 2019. According to Navexa, we are up 17.05%. That's CAGR per annum versus the benchmark, the STW, which is up about 7.93% per annum over the same period. So that looks good still. Of course, for the financial year, we're still nowhere near the benchmark. We're up 6.41% for the financial year versus the STW, which is up 21.2%. So as we've been talking about, it's having a corker year. A lot of money flowing back into the markets. It's been a kind of crazy week, though. RBA, we mentioned on our show last week that the RBA was going to come out with a interest rate announcement, and they did. They pushed it up yet again, and the market was shocked, surprised by this, apparently, Tony, because the market's crashed.
Yeah, it's. I think what they were shocked and surprised at is that they thought, I think 0.25% was probably expected, but and it's pretty difficult to tell what the RBA is doing, but the market kind of formed the opinion that we're nowhere near the end of rate rises, which is one of the things that the market had been reaching as a consensus earlier on this year, which is why the market, the main sort of indexes on the markets around the world have been going up, because they think inflation is being tamed and we're getting close to the end of rate rises and maybe even some rate cuts. So that was a rude awakening last week to the share market.
Rate cuts, really? They think we're close to those?
In the US, I mean, remember that the share market sort of is casting a long shadow, to use Roger Montgomery's words, and is looking 9 months in advance. And there was a school of thought, I don't know if that's still the case now after the last Fed rate rise, there was a school of thought which said that in order the inflation was coming under control, we're getting close to the end of interest rate rises, and if it looks like the American economy in particular is about to go into recession, there may even be an easing in rates. That's not so strong as an opinion in the market at the moment in the last week.
Well, apparently the US market was up last night because the All Ords had a huge recovery this morning. It had been going downhill for the last 3 or 4 days and then spiked up this morning. Everyone got all excited, but it seems to have been coming back since then. So at the moment, All Ords is trading at about 7633 off of like a week ago. It was at 7734, closed yesterday around 7608. So it's up a little bit, but you know, it's kind of choppy. I had to trade a bunch of things last week after the RBA announcement came out. And, you know, we've had commodities that are struggling as well on top of that. But I guess it's just business as usual, really, isn't it?
It is, yeah. And, you know, a couple of points. I sent you an article today about the RBA governor. I think there's a bit of turmoil going on at the Reserve Bank. I suspect that the PR spinners over there are trying to keep him away from microphones and cameras at the moment, because since he gave some guidance in the past, which said interest rates wouldn't rise until 2024, which has caused a lot of problems for him in particular, but you know, perhaps for the economy as well. So for the first time that I can think of after an RBA board meeting, he didn't come out and speak to the public. Now he said, okay, I didn't do it, but that's because I'm going to the Senate Estimates Committee this week, and all will be revealed during the questioning at the Senate Estimates Committee. So, okay, that normally happens as well as the RBA fronting the media after a bank meeting. But the really strange thing, which I think has probably sealed his tenure at the RBA as finishing this year, is that he didn't front the media, but he went along to a meeting of all the big banks trading, what they call it, their treasury departments, their treasury traders, and spoke to them behind closed doors. And, you know, that's not a good look. The bond market moved after that meeting, even though he put out a press release saying he didn't say anything more than what was said in the press release following the RBA meeting. But something was said or intonated or expressed or inferred at a closed-door meeting to move the bond market. So I just don't know what he's thinking. I mean, again, all of these things are normal for an RBA governor. He wants to move the bond market. If he can do it by what they call jawboning, talking to people like bond traders, then great. He doesn't have to put up interest rates. So I don't know what's going on, what the strategy is. It just strikes me anyway as an outside observer as that there's a bit of panic going on over there.
I've come about the watch, mother. The watch is what he said.
Yeah, well, it's the RBA is under review, so this is all playing into the hands of a change in potentially, a big shake-up at the RBA. Central banks around the world since about the inflationary shock of the late 70s have all had this driving mandate of independence. And you can't make us political because then governments can move interest rates to suit their own agendas. And I get that. But that argument's also true for every other department in the government. Right? Every other department in the government has a public service bureaucracy, administration under it, providing expert advice, and then it's up to the politicians to decide how or when or what to do with that advice, except for the RBA and interest rates. So I kind of like an independent expert panel setting interest rates for the economy. I think that's not a bad model, but it only works as long as they're competent or appear to be competent. And there's been a few 12 gauges to the foot in the last couple of years for the RBA. So it may be that they get hauled into line and become a branch of the Department of Treasury, and then they'll have a lot more influence from the Treasurer.
So you think
interest rates are going to be?
You think if the government was running it, it would be more competent?
No, not at all. I actually subscribe to the argument that an expert panel is a better way to run things than a bunch of politicians. But the risk in this kind of in our particular political system is that eventually, one government of the day is going to get sick of the expert panel either being incompetent or going against what the government wants, and they're just going to put their arm out and hook them back into being a branch of government. And I think I'm not saying it will happen, but it's a potential outcome for the review.
Well, speaking of reviews, there have been a lot of what would we say, confessions coming out of confession season. Guidance downgrades, I think, is the terminology that gets used. Star Entertainment, Star Casino's share price collapsed by 20.5% when they said that they're probably going to have to cop an impairment charge for all of the dodgy shit that they've been doing. There was JB Hi-Fi.
And look, before we leave Star, I mean, first of all, it's not on our buy list because it's had a qualified audit for a while, so that saved us from investing in it, because I think it probably would have been on our buy list otherwise, even though sentiment's been bad since the Royal Commission. But yes, they've got an impairment charge, but I mean, how lucky are they not to wind up with striped suits on in the big house? Because and it's not me talking. It's there was a judge I read in the Fin Review today who just said, "What the hell are you guys doing in the government regulator looking after casinos? It's taken a year now, and you still haven't started a prosecution against them. Pull your finger out and get going." So I think there's been a fair bit of regulatory capture when it comes to governments regulating casinos. And again, I'll be careful of what I say. I don't want to say much more than people have already said in the press, but there's a whole lot of reasons for it, and a whole lot of reasons why it happens. And one of them, I suspect, is that they've been horribly underfunded. If a government of the day doesn't want the government to regulate something, they put one guy in a
room closet,
in a shared workspace out in the western suburbs with a 2-hour commute every day, and that's how they regulate things.
It's the same guy that was apparently running robo-debt calls. We don't know who he was. Can't find him. No record of him. Sorry, what? Me? You, Minister? Did you know what was going on? No. What? Me? No, I didn't pay any attention to that. It's not my job. Not my job. Wasn't Scott Morrison's job to do anything about the fires, and wasn't that guy's job to know anything about robo-debt either. Anyway, back to confession season. JB Hi-Fi warned about slowing sales growth. Their share price took a 5.6% hit. Super Retail were down. Bapcor were down. Fletcher Building skidded 5.3% after issuing guidance downgrades. Orion Holdings was down 6.8% after guidance downgrades. So it's been a little bit choppy out there this week.
Yeah, so I think it's Horizon Holdings, which is the coal hauling company.
Horizon. Copied this from Ausbiz. Ausbiz had a typo in their thing.
Yeah. Anyway, just to clarify that, it's Horizon. I think the interesting one is JB Hi-Fi. It's a really well-run company, and it was only last month that we were all saying, look how great the results are going to be for retailers, because all the retail traffic is up, probably on the back of people shopping more with COVID because they can't go overseas and they've got more cash to spend, and now interest rates are biting, and the people are forming a different opinion as guidance is given. So that all makes sense, but it does point to how rising interest rates are going to bite in the economy. So that's going to be the feature of this reporting season, I think, and everyone's going to very carefully watch supply chain increases in costs. If it's a retail-facing company, what's the consumer doing? What's foot traffic like? What's like-for-like sales like? All that kind of stuff. But I mean, surprise, surprise, when interest rates go up, the economy slows. That's why the RBA does it. Whether that's going to solve inflation or not, I'm not sure, because as prices go up, people also put in more demands for wage growth. So that could just be a start of a cycle too.
Speaking of supply chain issues, I noted that the CEO of JB Hi-Fi, I believe it's a Mr. Smart, said that they don't have any supply chain issues anymore. Everything they want, they can get. That's all streamlined and running well now. I'm not sure if that's true across all industries, but that was interesting to read this morning.
That is, that's a positive note, because if that's the case, I think then inflation will come down, whether the RBA is right to raise interest rates or not, because that's one of the problems. On the other hand, I did notice as well that OPEC have put the oil price up and Russia's followed suit. So at least that part of the economy is still going to get stung with high prices for a while.
After Joe Biden apparently fist bumped MBS and asked him not to put oil prices up, he did it anyway.
Yeah, what's the price of a fist bump these days?
Let's talk about the thermal coal sell line. Daryl asked on Facebook what the sell price for thermal is. I plug the numbers into the 3PTL calculator. I get $172.95 as the sell price. Do you agree?
Yeah, I haven't plugged it into the spreadsheet, but just using a line on the graph, I got something just south of 200. So I had a look again today. It was around 175, 180. So yes, I do agree. I think that's about right.
Right. So it's been a bit rough for our thermal coal companies out there. NHC in particular, WHC, they've been taking a beating. YAL, YAL, another one.
Terracom, yep. And I mean, it's an interesting graph. You could fudge. I did fudge it a couple of weeks ago, in which case it'd just be a sell now. So it's one of those U-shaped bottoms to the graph. So whether you take an 8% flat bottom or increase it a little bit more, it becomes material to where the sell line is. So, I don't know. I mean, you're right to say it's in the mid 172 or whatever the number is, or 180 as the sell price. But if that's worrying people out there, they could fudge it, and you get a sell price now if you change the flat bottom percentage a little bit. But either way, I'm going to stick with the current sell price. I think there's room for coal prices to bottom out and come back up. I've got no real signs for that, but that's the whole reason for sticking with a commodity when it drops, is that it's hard because the share price is going down for the mining stocks that you own, but you must be getting closer to the bottom every day. It gets closer to that sort of resistance line. I did read a report from Ord Minnett, so from Alex Hayes' firm of stockbrokers, on research into the coal price, and they do a lot of work on how much supply is in the system, which companies have what stockpiles, what's driving demand, all that kind of stuff. And they said that they think the bottom of the coal price is going to be between $180 and $200. But, that's their model and that's their forecast, so who knows. But with such a steep decline, we should be getting to a bottom fairly soon, I would have thought.
Right. So you're sticking with the current sell line. You're not fudging it at this stage.
Yes. No. And I noticed I came close to a Rule 1 sell with Whitehaven Coal last week, which is one of the reasons I was focusing on the coal price. But it has gone up again since then. So, that's the other thing to take into account, is that the share price of the miner should reflect the share price of what people think is going to happen with coal. So regardless of what Ord Minnett think or what we think is a 3-point trend line sell, if the share price of Whitehaven is still going up, then someone or the market out there thinks that the price is going to rebound.
Well, speaking of rebounding, I just want to remind people that dividend season we are in. So before you sell anything, just check the dividends. I got a sell on my alert today for VUK, Virgin Money, and but luckily I checked and it has gone ex-div on the 9th of February. Payment date is the 15th of March. When I plugged the dividend in, it was no longer a sell, although I see it seems to have dropped again since then. So it's up 1% today. So it's still pretty close to a Rule 1 for me, even with the dividend factored in. But just a reminder, check your dividends before you pull the trigger on any sells out there. You don't want to shoot yourself in the foot with that. Let's talk
No, there's
about
nothing. It's happened to me in the past over the years, and there's nothing worse than selling because the price has dropped quickly, and then 2 months later getting a dividend check and going, "Oh shit, that's why it dropped." Now I understand. Yeah, so add the dividend back to the current price and see if it still breaches a sell line for you. And even I tend to add back the franking credits because they're worth something as well.
Yeah, I have that all built into my sheet now that automatically calculates that for me because I tend to forget that too. Let's talk about CDM. I noticed CDM on the buy list this week, and when I looked into it, it's a CDL. What? It's an LIC.
No, yeah.
What the hell is a CDL? I don't even know what that is. CDM is an LIC. I'm suffering from 3-letter acronym disease. Cadence Capital, CDM. You got any idea why it might not be getting filtered out in our filters?
Well, it's definitely an LIC, a listed investment company. I think the reason why it's not being filtered out is that the majority of LICs don't get what's called a GIC code, a GIC code, which is how the ASX allocates stocks to different industries. And we filter out all the ones that don't have a GIC code, but I have noticed a couple get called diversified finances. So they get lumped in with the likes of Credit Corp and actually trading operational finance companies, and it sneaks through on that basis. So it should be removed. And just for a recap, we don't like putting LICs on the buy list because one of our major metrics to decide whether to buy or sell a company is based on operating cash flow. And for ETFs and LICs, that can be affected by, other things besides the profitability of the underlying company. Like share redemption, share buys, etc.
Stock Doctor even says CDM is a listed investment company and as such does not have a financial health rating. LICs are effectively managed funds and are not actual companies. We can only assess financial health and our growth and or income golden rule criteria on an actual business, not a fund that simply holds investments. So similar sort of position to us, right?
Similar thing, yeah.
So just take note of that, folks. I'll try and make a note on the buy list for next week to remember to remove CDM if it keeps cropping up.
And look, no disrespect to Cadence Capital. It's been around for a long time. It's, a well-established listed investment company. It just doesn't fit the profile that we use to value companies. So we exclude them.
What else have you got on the news of the week, TK?
Yeah, so I was only going to say that there was something else to talk about with Whitehaven Coal. I did notice last week that a large shareholder sold a stake, so that is perhaps why it did start to flirt with my Rule 1 sell line, apart from the fact the coal price is declining. And the fact that trade went through and everything's hunky-dory might mean that that's why the share price has gone up this week, even though the coal price is still declining. So even though mining companies generally track the underlying commodity, there is other corporate activity which can, change that. But generally they do. So that's Whitehaven Coal. I did a couple of comments on pulled pork. I did a pulled pork on Channel 7 recently, 7 West, 7 Media, I think it's now called, and noticed in the last week that at least investment bankers are floating the idea of a merger between HT&E and 7, and the share price has gone up a little bit this week. So the curse of the pulled pork might be in abeyance for that one. And I'm going to do a pulled pork on Fletcher Building. And luckily it's February 14 and not February 13 because they came out with a profit downgrade yesterday. So when someone requested a pulled pork on FBU, the market heard and sold off the shares in between.
Well, the share price for 7 West Media is not doing great either. A week ago, it was trading at 47.5 cents. It's now trading at 43. It crashed down yesterday and today, so it was a delayed reaction to the pulled pork on that one.
The curse is aligned and well then.
Yes, it is.
Yeah.
And yeah, poor Fletcher
Yeah,
Building.
but look, what in terms of Seven, I'm not surprised that there's going to be some M&A activity. It's an industry facing a lot of headwinds, and so companies are just. I mean, every company looks for growth, and if you're not getting it from your basic business, another way to do it is to go and merge with someone or acquire them or be acquired. So, expect to see a lot more activity in this space. And speaking of that, I watched the Superbowl yesterday and noticed that Elon Musk was in the box sitting next to Rupert Murdoch and there's a photo actually of it in today's Fin Review. So they had the same idea I did. So the first thing I thought of was MySpace. Well, the second thing I thought of was, two peas in a pod two Bond villains getting together to rule the world. But yeah, you wonder why the owner of Twitter is talking with the owner of News Corp.
I know you don't watch Succession, but that's like something straight out of Succession. The old media guy meeting with the young whippersnapper billionaire, and they're trying to figure out, this is the last season, trying to figure out who's going to buy who and how it all fits together. They're trying to figure out a merger and, who's going to end up on top and who's trying to crash the other one's share price so they can end up coming out on top of the merger and the acquisitions. Yeah.
Exactly. And so it'll be interesting to see if anything happens and also who's the smarter of the two. I mean, the last time we went around with the dot-com boom, News Corp bought MySpace and it paid a lot and didn't get anything for it. So hopefully they're once bitten, twice shy if you're a News Corp shareholder, but watch this space. Yeah,
but the flip side of that argument is MySpace was a potential threat to News Corp and it's not anymore. So yeah, a lot of these, I remember from the .com, the early .com, the original .com days, I remember when the big retailers started buying companies like Wishlist and D-Store, and then just, we're not going to change, sort of Rupert's old line, whenever he would buy a newspaper, like, we're not going to change, we love what you're doing, we're not going to change the management, we're not going to change the editors, the editorials, it's all great, we just want to play, we just want to own it because it's great, and that would last 6 months to a year, and then the Night of the Long Knives would come out and it'll be, at least they would keep them on board, but when the big corporates buy the .coms, they tend to just shut them down because, they know the old world, they don't know the new world, right?
Well, yeah, this is all speculation. I did also think that it's interesting that one of the first things Elon did when he took over Twitter was to invite Donald Trump back on and to, take all of the checks and barriers away from free speech and hate speech and things like that, or most of them anyway, on Twitter, which would be right up Murdoch's alley. I mean, if he can recreate Fox News to the young kids on Twitter, that's got to be attractive to him.
Yeah, Elon allowed hate speech unless it was hate against him. Then he was kicking people off.
Yeah, and he put out a quiz or a survey saying, should I run Twitter or not? And everyone came back and said, no, you're an idiot. And he's still running it. So.
Well, yeah. Opinions are only worth so much, really. All right, so who are you going to do a pulled pork on today?
Quick, grab your stockbrokers and get ready to sell. It's Fletcher Building, FBU. Right,
FBU.
And the only reason I'm doing this is because it was a request a week or so ago. So thanks for the request. And we were asked for two, Regis Resources or Fletcher Building. And I think Fletcher Building is more topical at the moment, given their results are out tomorrow and there's a downgrade announcement out yesterday. So I'll talk about that, but also too, I think it's still on the buy list. So I'm not sure if Regis is on the buy list. So I'm going to do Fletcher Building, this week, and then I will do Regis next week.
It's a good strategy. A good strategy to wait until the share price crashes, then do the pulled pork. So we can't get blamed for the share price crashing.
Well, it's a good strategy if you have a company you're a bit worried about. Email us and say you want it to be done as a pulled pork, because then you got least a week to to get out before we analyze
you
it.
do it.
Yeah.
All right. I forget.
Yeah. So let me just find my notes on FBU. But yeah, so Fletcher Building, for anyone who doesn't know, is a large construction company. It's New Zealand based, but it also operates in Australia. It's one of New Zealand's biggest companies, so it's considered blue chip from that perspective. It also does retail building products, including concrete, but also things like Laminex and other building products that are used in building new apartments. And it also is a developer, so it does also sell into the housing market, retail housing market. So you do find, if you have a look at their assets, that they do land bank, and then they will build and then sell off developments into the residential space. And that's been good and bad for them. They're pretty good at managing the cycle. And one of the things that they spoke about during their confession season announcement yesterday was operating cash flow had been high in the last couple of years, because with a strong residential market due to all the money staying onshore during COVID and people working from home and wanting to buy bigger and better homes, they are quite savvy in releasing land into that market and developing residential lots and selling them off. They're now announcing they're going to reverse that, and they're going to start refreshing that land bank now that property prices are coming off in the residential space. So that will be a drain on operating cash flow for the company going forward. And so that's an interesting thing for us, because operating cash flow is a big driver of our valuations for companies. So we'll see what happens. The numbers I'm going to give you are based on numbers which are now 6 months old. And the new numbers are going to be announced tomorrow, even though there was some guidance given yesterday in the announcement. And the guidance yesterday was mainly about 6 months hence, when the end of financial year numbers are released. So the numbers released tomorrow for the half, and they should be pretty good. It's, as they say, it's been a strong half for them. It's only going forward that they think they're going to have a slowdown. And part of that reasoning is because there's been a lot of wet weather in New Zealand in particular, particularly Auckland. So, thoughts go out to our Kiwi mates that you're doing it pretty tough over there with another rain. I wouldn't call it a cyclone, but another rain depression hitting Auckland pretty hard in the last 24 hours. So that environment's not great for construction companies. They obviously send everyone home on wet weather days, and so they can't do much work, and that affects their bottom line. Again, that's probably temporary. So it's always hard to look. You need to look through it sometimes, some of these things. It's always hard to know what to do. So that's why we focus on the numbers. So I guess my recommendation out of all this is, if you hold FBU, wait and see what the results are like, and when they come into Stock Doctor in a couple of days, and then drop into our buy list, have a look, see what the share price does. And I am doing this analysis today on the February 14th, 2023. Share price is 443, and that's only 20 cents above the 3-point trend line sell. So if the results come out tomorrow and they're not received well, the share price could go below our sell line. So that's one thing to bear in mind. And it's also currently a Josephine, following the fact that it dropped, I think, about 7% yesterday after the announcement was released. So you wouldn't be buying it today anyway. But yeah, might be one to watch as we come out of the new results when they drop. Reason why I say that is it's a well-managed company, and the QAV score for quality is quite high with this. So I'll run through the numbers now. It's a large cap stock. ADT is $2.6 million, so that should suit almost all retail investors who shouldn't have any problems getting in, and more importantly, getting out with an ADT like that. The financial health of this company is satisfactory and steady, so that's good for us. I do know that satisfactory, not strong, but satisfactory still scores for us. But interesting to note, when the results come out again, if there is a deterioration, that could become less than satisfactory, which would be which would reduce the score for us. This might be a problem in Stock Doctor, but I did know that there's nothing recorded for directors owning any shares, which I find quite strange because not even the MD or the chairperson has shares, which they usually get as part of their remuneration. So it could be the fact that it's that information simply doesn't make it through to the ASX because this would be a dual listed company. So we may have to dig around and find that out. But I would be surprised if there's any owner founder in this company. It's been around for a long time, and typically a big blue cap company like this will have, corporate types running it now rather than founders. So I'm not that worried that we're not seeing it in Stock Doctor. Prop cap for this company is currently 6.81, so it's just within bounds for us. So that's, again, something else to look out for when results come out. If the share price does drop, however, that will help the prop cap for this company. So it may be one that we just watch for a while and wait for it to come back up again if it continues to drop. ROE is only 11.6, and that makes sense because this is a capital-heavy business, and so it does have a lot of assets and, as I said, a lot of land and equipment. So you're not going to get a great ROA off all that, and possibly not a great ROE. And plus, the construction business, as well as being cyclical, is also fairly low margin. So, which is one of the reasons why large companies tend to dominate, because they can weather the storm and survive on thinner margins. The price is currently greater than IV1 but less than IV2, so it scores 1 for that. Interestingly enough, the company has a net equity per share of $4.34, so it's trading close to its book price, and certainly less than book plus 30%, which is $5.64. So this looks like the kind of coffee shop, to use our analogy, that people want to buy based on the actual property rather than the underlying business. So that's interesting, but there are companies which are valued on their assets and companies which are valued on their discounted cash flow, and this is one which appears to be trading around its book value. So that's a score for us on that basis. The other interesting thing about, I think, the current situation anyway, and it may change in a couple of days, is that the earnings per share growth is still in Stock Doctor to be forecast to grow 23%. When the financial year concludes in June 23. I suspect that will probably change. And the reason I say that is that's based, the forecast growth is based on earnings per share, and we don't have a guidance for earnings per share from the company in yesterday's announcement. What we do have a guidance is for EBIT. And the EBIT guidance was between 600 and 660 million. And 6 months ago, at the last financial year results, it was 550 million. So that's not a 23% increase in EBIT. And there'll be some slight differences, but EBIT growth generally tracks earnings per share growth. So we may see that forecast revised down. But at the moment, this company is yielding a high yield, which is above the bank rate of 7.81%. So interestingly enough, we have a high growth stock and a high yielding stock, which is kind of a nirvana for a company. So I suspect one of those will change. And I suspect it'll be the forecast growth, which will drop based on yesterday's announcement, and probably based on the numbers when they drop into the spreadsheet yesterday. So watch out for that. Something else that will change is that it's still recording a 1 in our spreadsheet in our manually entered data, because it was a new 3-point trend line upturn after its last results, and it will lose that status most likely tomorrow unless the results are well received and the share price ticks up again. But I expect it to go back to a 0 score for us going forward. All in all, though, the quality score for this company is 15 out of 16 items, which is 94%. And the QAV score is 0.14, which puts it towards the bottom of our buy list, which means that it could well drop off the QAV buy list tomorrow when the results come out. But certainly something to circle back and watch in the coming days. It's not without its risks, and that will also be factored in by the analysts and the big funds who will be paying attention to Fletcher Building, or Fletcher Construction as it's now called. The risks are hot, obviously rising interest rates, and they've been rising earlier and harder in New Zealand than they have in Australia, from what I can see. So the New Zealand housing market's probably more subdued than in Australia, although I haven't paid close attention to it. But anyway, rising interest rates means residential property is declining in value, and that's one of the spokes to the wheel of this company. So that part of the business will suffer. They do other work, of course. Like I said, they supply concrete to commercial properties. People have probably seen Fletcher Construction or Fletcher Building on cranes around town, so they still will have that business. But interest rates will hurt a lot for this company. So that's a risk, even though it's, like I said, in a sweet spot of high growth and high yield. Let's await the results and let's watch the sell lines and see what happens.